Howdy friends, Dollars and Cents here. Central Florida's longest running radio program, also happens to be one of the top 25 financial planning podcasts on the World Wide Web. If you're interested in subscribing to our podcast or our YouTube channel, you can certainly simply search for us on your favorite podcast channel or social media network or YouTube itself by simply looking up Nelson Financial Planning and subscribing to us there. If you have trouble finding us, just go to our website, Nelson Financial Planning, and you'll see a bunch of different icons. Click on the one that looks most familiar to you, and you will get directed immediately to our podcast and YouTube channel. So we look forward to adding you as a subscriber in those formats. My name is Joel Garris of Nelson Financial Planning, and we're talking in this segment a little bit about some potential pitfalls when you inherit money. And most people say, well, if I inherit money, that's, all kind of sunshine and rainbows. That's found money. That's exciting stuff. But remember, it's a double-edged sword. I mean, the reality is that probably somebody you loved or was family, friends, acquaintance just passed away. That's kind of how an inheritance happens. So that's not necessarily a good thing. And then there's also some significant tax implications that you need to kind of really understand how that works. We saw just this past week somebody not really appreciating those tax consequences, and it wound up making a difference of over $20,000 on a $100,000 account for this particular person. Seems to me that if you're inheriting $100,000, you want the whole $100,000, not 80, right? And so that's why you have to be careful in terms of what you're doing when you inherit anything. And it starts with a couple of initial questions that we talked about in the last segment. Number one, how is that distribution coming to me? Is it coming to me in a lump sum, or is it coming to me over time? What options do I have in terms of the timing of receiving that money? And then, second of all, what's the tax nature of that money? And this is where we're going to spend some time in this segment really digging into that, because the tax nature is a big part of what the implications are going to be as you inherit that money. And basically, from a tax nature, you want to think of it as kind of two different categories. There's qualified money, which is basically thought of as retirement money, and then there is non-qualified money. And set aside how the money is invested, whether it's in mutual funds or stocks or bonds or real estate or annuities. Understand that fundamental difference between something that is qualified versus something that is non-qualified. On the qualified side of things, you have IRAs, you have 401ks, you have annuities that are invested in retirement accounts. You can have all kinds of those types of accounts. The bottom line is, if it's a retirement account of some nature, it is a qualified account. And so the next thing you have to be thinking about is, okay, well, are you the spouse of the person that passed away, or are you not the spouse? Because that then gives different options for you in terms of your ability to receive this money over time, or whether you can simply assume it as your own. Spouses have a lot more options in which to pick from, and in fact, the spouse, and only the spouse, has the option to assume the retirement account as their own. That's an option that is unique to spouses. If you're not the spouse, then the rules for distribution of that money have in fact changed pretty dramatically at the very beginning of this year under the Secures Act. We've long forgotten the Secures Act in the midst of all of this COVID crisis and the CARES Act and all that sort of stuff. But the Secure Act, which was passed at the beginning of the year, was pretty widespread in terms of its changes that it made to retirement accounts, and also the flexibility of beneficiaries to receive that money. And what the Secure Act did, besides increasing the required minimum distribution age from 70 and a half up to 72, it also wound up changing the option that beneficiaries had to spread out retirement distributions over the course of the rest of their lifetime. Now, they have to take it out over the course of a 10-year period of time. Again, spouses are unique. They can treat that as their own and ultimately spread that out over the rest of their lifetime. But a non-spouse beneficiary, now you've got to work sort of with that 10-year period of time. And it's so important to kind of understand that when you have these options, you've got to make sure that the paperwork is being done correctly. At no point in time when you inherit an IRA should you ever be taking that money and putting it into your own IRA. That will not work. That will be treated as a distribution. If you inherit a retirement account, you inherit an IRA, you inherit a 401k, you've got to set up an inherited or beneficiary IRA account that's going to have the name of the person who passed still on it as part of the registration. That's how to properly set it up to make sure that the tax implications don't hit all at once, to give you the flexibility to take that out over a period of time. Be very careful about doing lump sums because all of that is going to be taxable in a particular year. So just be aware on the qualified side of things, traditionally retirement accounts, you've got some flexibility. You've got more flexibility if you're the spouse to assume that as your own. But if you're not the spouse, then you've got to be thinking, okay, what's the best strategy to take this out over a 10-year period of time? And here's a little nuance on that 10-year period of time. You don't have to take it out the same amount of money every 10 years. You can take 2 or 3 years off, but just know that you've got to take it all out over a 10-year period of time. There's not a requirement to take out a certain amount of dollars each and every year, as opposed to the old rules which said you've got to take out an amount each and every year in order to be legal on an inherited retirement account. So again, rules on that have changed a little bit, a lot, to be candid, and you certainly want to take the time to really understand that. Now, we talked about qualified money. Let's flip over to non-qualified money. So non-qualified money, three categories to really be thinking about. First, if it's a stock, if it's a property, if it's a mutual fund, those types of assets, there's something called a step up in basis. And what that means is that if the folks that bought it only paid $10,000 and now the value is $20,000, then the step up in basis means that now for tax purposes, your basis is equal to the value at the time that that person passed. So that's very powerful. That basically means that you're going to be able to get that asset without any taxes. Similarly, life insurance. Life insurance, you don't have to worry about any taxes when you receive life insurance proceeds. So both of those, between the step up and life insurance, both of those would come to you without any tax implications. And then lastly, if it's an annuity that's not an IRA or qualified annuity, if it's a non-qualified annuity, know that the portion that is the profit, that's going to come to you with taxes. Once you get down to the original investment, then that comes without. So as you can see, depending upon kind of the nature of the type of account, depending upon the nature of the investment product, there's certainly some different tax implications on it. So we really encourage folks to really sit down and kind of go through these steps to really make sure that they are not creating a problem when they inherit money, that they're able to plan accordingly, plan properly, and make sure that they have all of their bases covered when it comes to inheriting money and minimizing the potential cost and tax implications on it. So certainly something to think about. We're going to get on out of here and wrap it on up. Thanks for listening on the end. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning, News Radio, WFLA, and 96.9 The Game.